So what do you do now as an investor? Where do we go from here? There are so many uncertainties in this environment. What's going to happen with the regional banks? Is there more risk in the system that is hiding, that is yet to emerge? And over it all, what is the Federal Reserve going to do next week? Let's get some counsel from Tony Dwyer, Canaccord Genuity Group Chief Market Strategist. Give us all the answers, Tony. What should we be doing in this environment?
I think my history shows clearly I don't have all the answers.
Yeah. None of us do. It's okay. It's okay. So how are you thinking about, what's your framework now for thinking about all of those uncertainties in the market?
So, Julie, as you know, I've been cautious for the better part of the last year, 9 months. Here's the issue. You have a Fed that has raised rates in a historic way. You've never had the rate hike cycle this fast. Even when you go back to the Paul Volcker era, or any other cycle, you have not raised rates this quickly. The problem is when Paul Volcker did it way back when, in the early 1980s, you were at a generational low in debt to GDP. We're at a generational high in debt to GDP, and that doesn't even include the private debt that's funded private equity and private credit and ventures. So a lot of the issues that are coming out now are, the long and variable lags, which is annoying as all heck to hear that every other sentence from people like me. But this is the implication of that. We're just basically 6 months away from that first 75 basis point hike, much less the next 3. So we've got a little ways to go here before bad news is really discounted as bad news and it's time to be aggressive.
So what do you believe is the next shoe to drop in that long and variable lag, and ultimately what you're describing within this outlook for still some pain that is yet to come?
Right. I think it's really inappropriate for people like me to come on TV and pretend like we know the next shoe to drop. Obviously, nobody saw the Silicon Valley Bank thing a week ago. So let's put that up on a mantelpiece. Let's talk about what we can analyze and don't have to guess at. And that is financial conditions. You've been in a situation, again, for the last 9 months where you've seen rates go up, which means interest expense goes up. You've inverted the yield curve. So when we ask the question, we've already tightened monetary policy to a degree and financial conditions to a significant degree. Do all these banking issues help or hurt financial conditions? And most certainly it's going to tighten them. So you've always had a recession when you've inverted the yield curve anywhere near the current degree. You've always had a recession when the Conference Board leading economic indicators have hit the current levels. You've always had a recession when bank lending standards have been tight to the current degree, much less what's going to probably happen after the bank issues. So what we can analyze rather than try to figure out the next shoe to drop is how does the economy go into recession? And that's been our call. It remains our call. And I think the banking issues reinforce that call.
And so I guess then the question is, why the heck would you want to take risk in this environment, right? So if you do want to be more cautious, if that is the scenario, and certainly the last week has not made you feel any safer in this market, I think, you being everyone, how do you do that then? How do you wisely avoid risk and still get a return?
Julie, as you know, there's always times where the market gets oversold and it can have this, kind of counter trend rip. We're getting pretty close to being oversold where you can bounce, but ultimately to really take risk, we haven't been there. We don't expect to be there near term. Our framework has been to be quote unquote light and tight, meaning, lighten exposure. So if you have excess exposure, lessen it. And we would rather be slightly defensive. But the key is, and I think the most important differentiation that I can give versus some of the people like myself that come on is the 3 stages of a bear market are: first, good news is bad news because it means the Fed's going to raise rates on higher economic activity and elevated inflation expectations. Then bad news becomes good news because, whoa, maybe we can get a soft landing and the Fed won't raise rates as much. And then ultimately, when all those indicators I talk about before we get to the current level, bad news becomes bad news. And that's the bull story. The bear story, the worst case scenario, was always a soft landing because it keeps the core services that the Fed watches so closely elevated. You unfortunately need to have unemployment go up. Unemployment goes down on an escalator and up on an elevator. And when it starts to go up on an elevator, that's when you want to attack and take risk. We're getting closer to that as bad news becomes bad news.
Okay, and so that started to answer some of my question as to what the green light might be for perhaps getting to the other side. But I guess on the calculus of how severe a recession might be, where are the clear plays that investors can lean into if they have a long enough time horizon?
Well, right now, short-term T-bills, even as they've come down, offer a pretty good safe haven there. But again, we're only saying that we want to be slightly defensive because the problem, Brett, as you know, is when you're in a whoosh, it's a technical term, but when you're in a real whoosh, people get all bearish. Kind of look now, all the bulls are kind of flipping, saying that there's risk in the system. The odds of a recession are going up. You think? So what happens is people start to get more bearish as stocks go down. In this phase, when bad news becomes bad news, if you're too negative already, it's going to be hard to change. So I don't want to get too negative. Time to be really negative was last June and last spring when some of the stocks were 75% higher. Now's not the time to get excessively negative because the Fed is obviously going to shift. The 2-year note yield's telling you that. I want to attack that new low if it comes rather than try to fear it and play for it, because I think that's the opportunity is when the Fed begins easing financial conditions and we can look through the coming economic weakness. That's the time you want to become more aggressive. And I think that's why the bull story is actually more sharp economic weakness rather than some kind of soft landing.
Gotcha. Makes sense. Thanks for talking us through it all. Tony Dwyer, Canaccord Genuity Group Chief Market Strategist. It's always great to see you. Thank you.
Thanks for having me.